if anybody feels excited and or brave, feel free to throw in the chat what you're up to or what you're looking forward to over the next couple of weeks. I've been hearing that most states have had at least a few good sunny days in the last week. So I'm happy to hear that as we all try and thaw out after a pretty hectic year. Also been hearing, just a fair bit of perhaps more than mild fatigue occurring across the ecosystem. So appreciate you being here. And if you're anything like me as a founder, you'd be, either, planning for a round, thinking about your next round. So, December, January, great time to be doing a lot of that preparation work as well, I would have thought. So, hopefully we can help you guys understand if and when you should use a safe, and if you are, how to make the most of it, how to avoid tripping up on a few things. And look, where this was born, I think David and Quentin and I were having a chat with Rain one day. Actually, Rain Ong had organised a little get together for some angel investors, and we were talking about the safe and how we all quite fans of it, but it's not a super simple document, not quite as simple as people think it is, and there's a few things we'd like to improve. So we've spent some time together, talking a lot about that. We've recently released a blog on that. We're working towards a safer note together as well, and together with some other sort of leaders from the ecosystem. So that'll be coming out soon. But look, today we're going to talk, a bit about what is a safe. It is a great way to raise. There are some real benefits to it. But when and why would you use it? What do you need to look out for? Like anything, when it comes to your equity, you do need to get it right as often as possible. Please put questions in the chat as we go as well. I think it does help us to understand what questions you have. There's a lot of technical chat today. We'll try and keep things as simple as we can for you, but unfortunately, there will be some technical terms. So if we do talk about things that you aren't sure of, do ask, because this is the forum to sort of learn those things. I will say that nothing on here is legal advice. There are accountants and lawyers on the call, but no, we're not here to give you advice. What's happening in your circumstance will vary from company to company. This is a general discussion to help you understand the lay of the land better. If you need more specific advice, you can come and ask Kate. Talk to your accountant or your lawyer, and we can sort of help you out. So we do have a great panel. As I say, we have myself from Cake. I'm a former CFO. Obviously, at Cake, we do a lot of capital raising, cap tables, and safes and things like that. So, quite experienced, obviously, when it comes to this sort of thing. Three good friends of ours on the call here today. It's a really, really great panel. I'm sure you would agree. So, Dave, Kenney, and I have been working together quite a bit lately, trying to providing, I guess, leadership and getting our heads around how we can help the ecosystem. And I'll let everyone introduce themselves in a little bit more detail in a moment, because it's better than me talking the whole time. So then we also have Quentin, from now co-founder of Archangel. He's been one of the big drivers, really passionate about improving this safe instrument to help founders and help investors as well, actually, because there's always, two people involved in these transactions. Important we get the balance right there. And Josh has kindly agreed to join us as well. Wonderful repeat founder, I think, or, he's got Silo going at the moment, a startup alumni like Cake, and also recently run a safe round with Cake as well. So wonderful to have Josh here. So Dave, I might start with you, mate. Just if you could maybe just talk a little bit about, your experience with safes and, what you're up to and what you're looking to try and achieve from this discussion and with safes in general.
Okay, yeah, thanks, Jason. David Kenney. I'm a tax and corporate services partner at Chadwick. I guess I've seen hundreds of different types of safe notes, and whilst I think that everyone on this call thinks that the safe note has a great spot and it does a lot of good stuff to help founders and investors, it's just some of the lack of clarity around some of the terminology, and also particularly the different definitions that really needs some clarity so that everyone's on the same page. We're going to cover a lot of those in today's call. I guess I'm busy with everything from capital raising to building revenue models and helping founders with all the different challenges from going overseas and setting up in other countries and hiring people, etc. And it's great industry to be in, and helping founders is a great deal of fun, and seeing some great results lately. So that's been very pleasing.
Yeah, definitely a great year for results. Just saw Blackbird's report out on hitting 10 billion in their fund. Absolutely wonderful to see the big year. And look, Dave's one of the most respected and experienced guys in the startup space. So really, really happy to have you here, Dave. Now, Quentin, over to you, mate. Look, the Archangel, obviously, you've got a wonderful group of people there, and doing some awesome things in investing, and yourself as a lawyer helping us here. What's your thoughts, mate, on SAFEs and what you're trying to get out of this too, please, mate?
Well, thanks, Jason. I'll just do a little bit of an intro. Obviously, I'm Quentin. I'm a reformed lawyer, ex-lawyer, maybe. Well, you're never not a lawyer, as they say. But yeah, I used to work at a big law firm called Allen's. Did a startup, we shut that down, and then joined a company called Culturamp as sort of the first 30 employees, the first legal hire. Went on that journey for about 4 years. It was a very, very exciting, but also great opportunity to learn a lot. So I've seen a few things over the journey in the startup field. Now I am one of the co-founders and partners at Archangel Ventures. So we have a bit of experience with SAFEs, given that we're a pre-seed and seed stage fund. So we actually do a lot of investments via SAFEs. In terms of the SAFE, I mean, one thing we really got to acknowledge is that we are standing on the shoulders of giants a little bit here. We can see a lot of the issues that have risen over time, and we're very passionate about fixing that, but we need to recognize that the people that innovated and created this document actually did a really good job and really moved the startup ecosystem, both in the US and Australia, significantly forward, and has made it much easier for startups and for investors to invest in those startups. So yeah, I mean, I think it's a great document. It certainly serves a purpose, but there's always pros and cons with every document, process, whatever it is. And so you need to be able to understand when is the right time to use a SAFE, when is the right time to do a price equity round.
Awesome. Thanks, Quentin. And look, possibly the VIP on the call, someone who's actually recently used a SAFE, got it done, very recent first-hand experience. Josh, thanks so much for joining, mate. We're really looking forward to hearing your insights as well. Do you want to say good day to everyone? Let them know. Maybe tell us a little bit about Silo as well. Super interesting project.
Yeah, sure. Thanks for inviting me. So Silo is a preclinical biotech. We're researching psychedelic-inspired medicine to treat mental illness. And we used Cake and Safe Notes to raise our pre-seed round. It was a great experience. I've used Safes a couple of times, both from the fundraising point of view as well as the investor point of view. I think they're a great instrument. Sure, there are things we can improve about them. And yeah, happy to share my experience, which was a good one. Cake was great. Awesome. And the Safe Note was, great, but could be made better.
Thanks, mate. Checks in the mail. All right, so the basics. So Dave, I might throw over to you, mate, just to help. There are a couple of people in the chat that said they're quite early in their journey, and like one of the things I've learned around raising capital is every time you go to raise, no matter how much experience you have, you're going to learn something new, and it's probably not going to go quite how you expected. So, even for the people that are experienced, I think we could do with a refresher. So, mate, do you mind just talking through some of the basics? What it is, the discount and the cap and some of that stuff, please, mate.
For sure. Well, firstly, it stands for a simple agreement for equity. So in other words, it's not debt, which is a good thing, but it's also not an issued share yet. And I think that's the high level stuff. Some of the stuff more under the surface and can be different in different agreements is it sort of starts with either a discount, so that it is a discount price to the next raise or the first fully priced round. So some of the rubbery stuff around that is, well, what would constitute enough money to be a fully priced round? What would the discount be? And what is the cap? And so these are, I guess, some of the three key ingredients of what the a simple agreement for equity. The safe note will convert to when it becomes a share. So this is the, so it's firstly, it's not debt, but it does interestingly sit on the balance sheet as a non-current liability, for example. It's not disclosed to ASIC because it's not a share. It is essentially a long-term, it sits as a long-term or a non-current liability on your balance sheet. And it's something that you need to keep an eye on for the moving parts with all the different things like ASIC, looking at how it really affects your dilution. What's your cost of capital really? And so there's a whole bunch of different things that need to be considered, but the basics are it's essentially, you know, seen in its best light to get money in faster because it slows down the friction or stops the friction of getting the price round where people might say it's too early to really have a robust discussion around what your valuation is. So that's really, I guess, why it's had so much prominence. As Quentin said, this is really a very great document that's adopted in so many circumstances. But potentially what we're trying to do is to try and simplify this so everyone understands how it fits together, because I don't think there's such a thing as a standard one when you look at all the different ways you can have different dilution issues in terms of pre-money, post-money, pre-ESOP, post-ESOP. There's a bunch of different things. And for me, I think when we started talking about this was just to try and work out how could we make sure that the founders and investors know what the impacts are for choosing that lane.
Absolutely. So we do have a bit to dig into there. The one thing I think maybe we can cover straight away is the discount. It's a very simple part of the safe, but even the discount can create some issues for the founder. So maybe we tackle that a little bit. Might throw it over to Quentin to talk a little bit about how you might set the discount and what the factors that you would take into account, as a founder and even an investor, if there's investors on the call, what you'd be looking for, when setting and reviewing the discount on a safe.
The discount's probably one of the few things that's actually become fairly standard in Australia between...
Oh, I've been seeing so many different ones.
Have you?
Lately, I've seen them from 20 to 10 to 0.
I would say the most common is a 15 to 20 like discount. From an investor's perspective, I would say a cap is more important than a discount, but everything's in the context of when the actual next round, the actual priced equity round will be. That's the thing that people miss. If you've got a discount and it's years away and you've got no cap, then founders getting a great deal because they're using your equity and for a very long time. Using your capital for a very long time, and you're not really getting much benefit. If it's
I've seen that as well. As a founder, if you're going out, say with a 10% discount, or you're trying like no discount's probably pretty uncommon. Just say you've got a smaller discount and your round is more than 6 months away and you're not getting calls back from investors, that's probably why. Investors are trying to double their money every year on an early stage deal, at a high level in their mind. Correct me if I'm wrong, Quentin, right? So if you think about a 10% discount, so that's 10 over 90, so it's somewhere like a 12% return. So that's a very small return for anything that's over a short time frame. And the investors are thinking that the only reason they would take that is if they think the next round is probably going to be at a reasonable valuation and they're not going to be able to get into the deal any other way. But if you think about fairness and balance within the ecosystem, we don't want to see this too much really because it burns the investors, and we need to look after the investors and keep that balance, right, which is why we see more of a 20% discount is 20 over 80 as a return. So then you're at a 25% return, which over sort of a 3 to 6 month time frame, which is normally the right time frame for a safe, which is more like a bridging round normally, you're getting into the right space. But if you're going to then, am I getting too complicated? If you're going to, sometimes we have note stacking as well, which then pushes the price round further and further out. So the discount is designed to, compensate the investor for the time that they have, that you have their money until you do that price round. So it is important that founders understand what that's for. And I do know that that's not obvious to a lot of founders. So yeah.
I think that's right, Jason.
Anyone want to add anything to that, or?
No, this is a good answer you've given. I'm sorry, Josh, I'll let you speak in a second. Maybe you should have done a lecture, just a lecture by yourself on that. Would have been actually very interesting.
Cool. So we've covered that one. Thanks, guys. Appreciate it. All right. So I just wanted to do that one while we were there.
Can I just
any
chuck
other
something in about?
Yeah, please.
I just wanted to throw something in. I think our fundraise was a bit unusual, but our safe had no discount on it. But I think a lot of this actually depends on the vertical that you're talking about. Like if it's, SaaS company, it's completely different than like we're biotech or deep tech. Like these types of companies, like, they're long-term R&D projects, which are going to grow exponentially over time, but that sort of horizon is a lot longer than it might be for a SaaS company. And so, it's probably the cap that's more important in that case. And like you guys said, the cap is in effect more important. But I mean, I think the discount, if you're looking at, value for cash, like it really depends, right?
I think that's absolutely right. And it sounds like we can't talk about the discount without the cap because, they do go hand in hand for an investor when they're understanding the major drivers, the basic financial drivers of the instrument. So how did you go about setting your cap, if you don't mind? You don't have to give exact numbers or anything, of course, Josh, unless you want to, but what were the sort of the drivers in your mind around how you would set the cap as a founder?
Yeah, finding comparables is super important. And for us, there weren't any because there are no psychedelic biotechs in Australia before we launched. So, what I did is I interviewed angel investors who had invested in companies like ours in the US and Europe to try and determine, okay, we're a concept stage company, like basically, team in a dream kind of status, what is sort of realistic. And what I found was it's a lot higher than what most companies establish as their cap or their valuation in Australia. I think part of that is just based on the sector as well, because, biotech companies in Australia just tend to have lower valuations, unfortunately. Which is something that I hope will change over time. But I basically took like, okay, this is where biotech companies in Australia are generally valued at our stage. This is where psychedelic biotechs overseas are valued, and sort of just took the average. But yeah, it is a bit finger in the air with these things, right?
Awesome. Yeah, I love that. It's tricky, isn't it, for founders? It's quite an opaque space. And one of the things there that we talk a lot about at Cake is just doing that preparation phase well. And a big part of that preparation phase is just talking to investors, building that relationship, asking them questions. And before you actually raise, have a good understanding of where the market's at and where they see your company in particular in relation to other deals that they see. Certainly going to help you when you actually open up, because, you're not going in with terms that aren't seemingly reasonable to the investors. So awesome insights there. So I have a few other ideas around how to set caps as well. Quentin, what's your thoughts on do you have any other drivers or factors that you see coming into setting caps?
It's just the market dynamics. So it's a combination of comparables, as Josh was talking about. Like, look, in SaaS, pure software companies, it's sort of pretty standard cap / valuations that come into play, 4 or 5 mil, then you get slightly larger depending on what it is. So it can end up being a bit of a negotiation too, right? If you set too high, then investors, you're either not going to get traction with them, or they're going to try and get you to reduce it. Set it too low, then you're sort of hurting yourself a little bit. So what would you do if you're buying a house? You go and find out what the houses are worth. So that's probably the way I would look at it.
Yep, great idea. And what about the concept of a term sheet with a safe? I think sometimes founders will go and they'll have a bunch of meetings and look for, I guess, the market to price their round. Do you see that happening in the safe. So sort of a little bit of a twist on what Josh was talking about. Do you see that happening in the safe space at all, Quentin?
I haven't seen that. I've seen other scenarios where founders have put a bit of a time limit on safes, and depending on the interest they've got, they'll start upping the cap.
Yep. So as they're raising a bit, so they might be raising a $2 million safe, they might get $1 million, and then they'll increase the cap for the second million or something like that.
I've seen that. I mean, you got to be careful. I mean, it's difficult because you want to reward people that are committing early, but you also want to be able to have parity in the whole round. Like, one thing you've got to remember is safes are it's not a round.
No.
It's you going out and doing individual investment, like negotiation with investors. And so it's
so theoretically on that, you could have 6 different safes with 6 different terms, couldn't you? Which you shouldn't do because this complexity is out of control. But if you needed to for some reason, or you wanted to, you can literally do 6 different safes.
You could, you can do whatever you want, really. I mean,
it's
I have
interesting.
an advisor recommending that strategy. Like, he's a US kind of incubator guy, and he was just like, screw the game. Just layer safes and raise the cap each time. And I mean, like, that might be a feasible strategy for some. I don't think it's particularly, sort of long-term oriented, and it gets really complicated. And there's other issues that flow on from that. But like, when we were raising, I kind of had our CFO, who I've been on a board with before, saying, like, you go out, test the market, see what the big funds come back with. And then I had this other advisor saying, like, just run at safes only. And like, I was surprised at how quickly a round came together using safes. So like, I sort of had this vision, biotech's expensive, I'm going to have to do a priced round. But then using safes and cake, it just like created momentum so much quicker.
Josh, but you set an amount that you wanted to raise, and once you sort of hit that market, you closed it, right?
Well, we went over that number, but you know what I mean. But
I remember I tried to get in a little bit too late.
You got the start mate FOMO factor.
Something like that.
Start mate help.
Look, I honestly, that's my sort of opinion as well. I definitely have seen the node stacking. I have seen different terms occur. At Cake, we were big proponents of simplicity on the cap table. They're very complicated things to manage at the best of times, and so the more you can sort of see the rounds as bigger chunks and manage them in that way, I think the better for the startup in general. Each round just gets more and more complicated, even though with progress, actually finding investors is easier. It doesn't necessarily make the round easier because the cap table can be more complicated. And even though, sorry, Quinn, I know you said a safe isn't a round, it isn't, but if you can sort of have it look like that on your cap table, it still makes it a bit easier to manage rather than having 6 or 10 different deals to sort of work through.
Well, 2 things, Jason. One, it's not a round because what it is, it's a future payment. It's a payment now for a future round.
Yeah, so, this is a really good segue into one of the other things, and the conversation is flowing well, so I'm not going to stick to my agenda too much. If that's hopefully everyone comes with us, ask questions. But what I like about this, and it's nice to actually think about it as like a prepayment on your next round as much as you possibly can, because it helps you look at your cap table in the right way. It helps you avoid some of the bigger problems. So I might throw over to Dave here. Dave, how could you look at that, as a safe, as a connection to your next round, and what problems can that help you avoid, and how do you see that dynamic?
Well, Jason, I think the first thing is that every capital raise is done very similarly in terms of creating some an understanding with investors, because I think having, to my mind, and I don't think anyone that says you just do it this way is necessarily right. I think that it's building that relationship and trust with your investors. So if you've got multiple different safe notes and you go, well, he got a better deal than she did. To me, I don't know how you explain that to investors if that's done. I wouldn't want simultaneously. It's like, I wouldn't want to be doing that. No. Yeah. So the way I look at it is you need to work out what amount you need to get to the next stage. And then you look at the blended rate, because you're looking at how much is that discount. And most, as you say, I think everyone thinks about 20% in the ballpark of what the discount is. But then you need to look at how much you're raising in the next round as well, because that is effectively what you're converting at that next round, give or take the discount or the cap, as the case may be. So in other words, what needs to happen is you need to look at, well, what's the overall discount of the two rounds together, because they effectively get merged into that second round. So thinking about how much you raise at the start and then how big your next round is, that will impact the overall price that you're giving a discount in the safe round. So to me, it's you need to think about how much you need to get to the next round and how quickly your valuation will increase. And then it just becomes a negotiation and trying to really help your investors make money, because that's an important relationship, because you want them to follow on. If you try and go and say, oh, I need a $20 million pre-money valuation with a uncapped or whatever the case may be, you're just not really doing this together. I mean, I know that the YC group were coming out and saying we're having uncapped notes and that sort of thing. I feel like that's to underestimate your initial supporters and really helping them along the path, because you want them to not just be money, you want them to commit. And so they're not going to commit and do the right thing by if you're not actually wanting them to succeed along the way, rather than being just the petrol in the tank. So I feel like that relationship is super important. I'm sure that Josh would have no different, and I know that Quentin would have feel very, very close to the companies they've invested in. So you're trying to, as much as possible, create a win-win scenario and say, look, let's just reduce the friction initially, but have something reasonable, because if it's too high, you're going to have a down round, or you're going to, if it's too low, the next round of investors are going to say, well, hang on, they're coming in at this. And it is an optical thing that people are saying, you want me to invest at 12, but these people are converting at 5. So it does create, even though there might be simple and faster at the start, it does catch up. And then you can miss out on other things, which I think you were going with the ESIC, because ESIC is like this breath of air that, one breath that you are entitled in this zone to be an early stage innovation company that is eligible for the tax concessions up front and also capital gains tax benefits. So the longer you go and the longer you wait to pull the trigger on the conversion, the less likely you are to be in ESIC territory, which is a really big advantage if you can get in. And it's quite complicated to get in, I think. It's not near as easy as Malcolm Turnbull promised us.
No, it's certainly not. They do like to complicate things even when they're helping us. But so really quickly, for a couple of questions, what is the discount on? I think we did cover that there, but just to make it crystal clear. So just say, for example, your Series A round is at $1 a share. If you have a 20% discount, the investors in the safe will get 80 cents a share at that point. So very, very simple. That's the discount.
Or a cap,
that's
or
how it
a
works.
collar. Sometimes, a cap or a discount. Sometimes it'll be the lower of. So let's say you have a $12 million valuation at your first fully priced round, and you had a 20% discount versus a collar of a different number. That might be different numbers, a discount, and you'll pick the lowest of if you're the safe note holder.
Yep. So the cap might happen. So just say the round is at $1, which is equal to, say, $20 million for pre-money val. You might have a 10 million cap on your safe. So that's half the pre-money val. So you'd be getting 50 cents a share. So, it's essentially either capping the price per share. It's capping the price per share either way, based on a hard cap or based on a discount. And it's normally either or. So it's normally the lower of either.
Correct.
And this actually is going to lead me to one of the bigger issues that I see from a cap table perspective, which is founders quite often don't understand what's going to happen if they're not successful and they've done a safe. And we're grappling with this at Cake right now. When do we do our A round? Do we do a safe in between? Safes can get you some, a lot of things done, if you're in R&D mode like Josh is, or if you're in growth mode like we are. It can get you a long way down the track before you need to do your price round. But just say, for argument's sake, your seed round is at a $5 million pre-money val. or 10 million or whatever. Let's say 10 million is a round number. Your seed round is at 10 million. You raise a $5 million safe with a 20% discount. And then you have to do an $8 million pre-money val on your next round. Like, I don't know if anybody's quickly done the maths on that, but you have just completely obliterated your cap table to the point where you're talking restructure. You know, investors essentially own your company unless, well, pretty much investors own your company. You've cooked it. So that's, for me, that's one of the biggest mistakes that can be made with a safe or a note, where you do too many notes or you stack notes and you have bigger discounts and you don't understand the maths. So, you know, does anyone want to elaborate on that, or sort of like help people understand the complexities of what that looks like and how to maybe navigate it better?
Well, one thing I would say is I wouldn't stack notes, like stack safes.
Oh, sorry, safes. Yeah, sorry, safes or
Yes.
notes. I mean, they're similar, very similar. Sorry, yeah, stack.
Yeah, well,
Safes.
I wouldn't stack safes. We should probably stop calling them safe notes because they're not actually safe notes.
You're trying to do that. Sorry.
People
Yeah.
agreement for future equity. But
Yeah.
yeah, one thing I want to, it just increases the complexity a lot, especially in the conversion. So, and what usually happens, David probably needs to help out here in these situations, but the lawyers try and do the conversions, and lawyers are not good at numbers. I can tell you that.
That's some weird spreadsheet.
I'm okay, but
hence
most of them get it wrong. So,
Yeah.
and it's also difficult in terms of doing the calculations. You've got multiple levels of safes stacked. So I think the overarching point from my perspective is that safes is a great way to kick off. It's a great way to get moving. But as David pointed out before, you've got to have in mind what the next round looks like, and you've got to be factoring in the stack of safes you're doing now with the next round, and so you make sure you don't get caught out, and it keeps that timing down shorter too as well.
Dave, anything to add on that? Or
you should be thinking at least 2 or 3 rounds ahead anyway, just to start thinking about how much capital am I going to need here? What's that going to let me do in terms of a burn? What am I going to look like then? What should I be able to raise at that point? And who do I want to bring along on the journey? And you might actually give a better deal to certain investors because you go, they're going to be more helpful. So it's pretty simple in that respect.
yeah,
Can I
and the
jump
last
in
thing
on
I'd add,
that
just look. Yeah, please.
Thing?
Yeah.
I actually have pretty strong opinions about this. Like, I don't think that investors should be investing specifically for the tax concession, right? Like, I also don't think there's any founder that is purposefully going to do the wrong thing for their investors. Like, for our round, like 1/3 of our investors are friends and family, right? Like, we're not trying to screw anyone over, but by the same token, it's like you have to do what's best for the business. In our case, like, we will remain in ESIC, as far as I'm aware, for a significant period of time because we're not going to have revenue, right? It's R&D oriented business. But like, I invested in another startup, and I asked them if they were an ESIC when the shares converted, or when the safe converted, and they said no. And I said, Mazel tov, like, that's awesome, right? It means that they over delivered. At the end of the day, like, I don't think that's any reason to do safes or not do safes based on the tax concession. It's like, you know, if you want a tax advantageous investment, then like buy property or something. Like, there are other ways to get benefit from tax incentives.
Look, I've done.
I think it's a good insight. It's good balance. I think it's all about balance, knowing how to do it right, doing the best you can. If you can get tax breaks, try and get them. Try and help your investors out. But yeah, I think if you could have been in Canva or not, and you didn't do it because of ESIC, you'd be pretty disappointed right now.
Well, just 2 quick things. No one should invest for tax reasons, really. But I always say it's a bonus. But just one quick one, Josh. There's also not just the revenue cap of 200. There's $1 million worth of expenditure in the previous year as well. So you can quickly fall outside of ESIC and you haven't converted your note, and then people go, "Why didn't you do that?"
Yeah. Totally. I know that. I get it. And like, you know, also when we were setting up, there was this talk about, okay, do we need to like do a flip to an Inc. if we wanted to raise funding in the US? And oh no, that will, you know, like ruin this ESIC benefit. And it's like, at the end of the day, it's sort of like, you know, ESIC, nice thing to have, shouldn't be the goal for any investor, but like, you know, there are a couple of reasons why it could get spun off.
Think about in this instance exactly. Sorry, there's a question about what is it? So it's ESIC. What is it? It's early stage investment company, right? It's
innovation company.
Oh, innovation company. Yeah. So early stage innovation company. So the tax office has special rules around that. If you want to check it out, we've got blogs on it. I'm sure Dave's got blogs on it, or Chadwick. Yeah.
So basically, whatever you invest, if you're a sophisticated investor, up to $1 million you can put in, you get a rebate of up to $200,000. So you get 20% of what you invest as a non-refundable offset. So you've got to have paid tax to get a benefit. So if you've paid $200,000 worth of tax in any type of tax, income tax, you can get that whole $200,000 back if you invest in an eligible ESIC company and you're a sophisticated investor. And then, but the main upside is the capital gains. So for up to 10 years, the growth on your share that you invested in is exempt from capital gains tax.
This is the big one, right? That's big. This is not a small thing. And as we're talking that example there, like if you did or didn't do that convert, like if you had a great relationship with your investors, but you just didn't think about it and then you didn't do it, and then you do go ballistic, like the difference between having done that conversion or not is huge, like huge. Yeah. So just good to be aware. Have someone like Dave on your team just monitoring these deadlines for you, and just like popping his hand up every now and then going, hang on a sec, maybe you want to do this conversion or whatever, can make the relationship between your investors a lot more squeaky. And what happens normally is after you've done it, the investors will come back and say, oh, did we convert? And you say no. And then, you know, like it's not the end of the world, of course, especially if you're doing well, but it would have been nice. Cool. All right. So I'm going to move us along a bit. I think this has been awesome. Lots of lessons here.
There's actually a point we haven't touched on, and I don't think anyone invests based on this thinking, but in terms of ESIC or not, but if there's more capital to return into the ecosystem, overall, that's a better way. And so for half of it's lost in tax.
The 20% on day one, not getting the 20% to put back in, plus another half in tax.
Yeah, I mean, and you want repeat investors. So that's the policy setting. And if you're destroying it by not allowing it to occur, then it's, you know, potentially a longer term problem, not a short term problem.
It's also just competitive too, because other countries like the UK have already had this, and it's really a cookie cutter in some respects with a bit more complexity.
And Singapore's pumping huge amounts of money into the ecosystem. They don't have a similar scheme, but you can get grants for just about anything up there. So
they don't pay
CGT as well, lower income tax. They're just printing money into the ecosystem. Like it's pretty amazing up there. So we need to utilize these things to look after the investors down here as best we can to keep money in the space. So yeah, it's important that we're across these things. All right, thanks for bringing that up, Quentin. It's a good couple of points to finish on that. We can come back to those if we get time. All right, so I don't know if we've actually covered why you would use a safe. We have a little bit, but I think, you know, perhaps I'll start with Josh, and I will go around the panel here to talk about why you would do a safe. There's quite a few good reasons why you would do one. Josh, why did you sort of choose a safe for yours? You touched on a little bit already, but do you want to just quick highlights on why?
Yeah, I mean, so I was getting these sort of two bugs in my ear. One was like sort of go down the priced round route, and one was just, you know, screw the man and run with safes all the way to the end. At the end of the day, my circumstance with Silo was, you know, I was in a huge hurry to get our round to come together, partly because like effectively my co-founder was at Sydney Uni, an academic that I was trying to lure to the dark side of startup world. And like, we basically had an agreement that, okay, if we are able to raise this amount of capital by this date, I will put in my resignation. So, you know, that that was part of it. The other part was that, you know, we talked to some of the local funds. It's like an unusual space. And I was basically like, look, if we don't get a term sheet by Wednesday, then I'm just going to start accepting safes from a number of these angel investors that we've been talking to, et cetera. So yeah, it's sort of one thing led to the other. And the minute the sort of train had left the station, as it were, it really sort of picked up speed very quickly. Yeah, using safes in conjunction with cake is like, I've had a tougher time getting RSVPs to in-person events than I did getting investors to sign on, because it just like made the process, you know, templated and quick and sort of seamless. You know, like the only back and forth was like, oh, it needs to be this trust or this company, or, you know, the entity that the safe was with was sort of the only complexity. It was like, once everything was set, it just went so smoothly. So that's how it happened for us.
Love that. Cal, did you capture that? That was a cracking one-liner. I might hit you up to use that one. Thanks, Josh. Look, and we absolutely love that at Cake. We've worked so hard on the different features, and to be honest, the raise feature is the hardest one because they're just such complicated transactions. There's so many moving parts, but I think the safe is an area where, if they are well standardized, like a software solution can really help you crunch through around and get this funding into the company. And I love how you were focusing on speed at the time. I think 9 times out of 10, when someone does a safe or a founder does a safe, it's for speed. Like, it's at the beginning when they're trying to get that first employee, or they have no money at all and they're just trying to get off the ground, or it's like in between rounds, like coming into Christmas, whatever, you know, or like some major opportunity arises, like their growth all of a sudden stands up really tall and they just might want to capitalize on it. So I think speed is like a real factor for safes. Quentin, what's your thoughts on why safes, mate? Anything to add?
I mean, Josh pointed out good reasons. I mean, there's both from the startup and the investor side, really good reasons to use them in early days, especially if you're an early stage fund like we are, like we're pre-seed and seed, like a round might not be built around, a large enough round might not be built yet. So it's a way to help the startup and the founders get moving. That maybe got some early traction, but they really need to demonstrate more traction to bring in the funds, which in Australia tend, like bigger funds, which tend to be a little bit more risk adverse than say in the US. So that gets you on your way, and then you have a good idea of what the next round will be, and then you probably do that round. That's where I think it works really well. So it's either where you're starting off and you don't want to spend money on legal fees, like you don't want to spend like 10% of your raise amount on lawyers, but you will have sufficient amount at the next round to do that, and you can get all your documents correct and so on. Or I would use it in a case where you need a quick bridge to the next round. You might even be talking to a lead. This is a little bit later on, maybe, you know, between a seed and a Series A, you're talking to a lead, they're very interested, but you just need to put a little bit more fuel on the fire, or you just need to extend the runway a little bit. And there's a view to the next round coming along quite quickly. So that's the kind of cases I think they work well, both for the startups and the investors.
Yeah, I love that. Dave, anything to add?
Yeah, just, I guess you got to look at where it came from. I mean, the YC, which might have had to make an investment in 100 companies within a couple of months, they can't do 100 valuations. So what their view was, let's just give these people $125,000 all on the same terms. So because it's not so much money, some companies could be further advanced than others. It's not that much money. So people go, I get all the benefits of Y Combinator, for example, or StartMate. And that's not that dilutive for the benefit I get. And so my thoughts would be to say, if you find the right investor, then it lets you get on with it quickly. And it is easier to do, but go into it knowing that in some ways the price round, even early on, might be a better way to start, maybe. But that's why I think people have adopted this, because they've said it worked for YC, why not me? And I feel like that logic works fine if you're struggling to get the right investor with enough conviction.
Love that.
And that's, I guess, my take.
Love
By
it,
the
mate.
way,
Yeah.
a couple days ago, Y Combinator announced, I read on TechCrunch that they're going to allow 1,000 companies per cohort every year.
Wow.
Or every semester or whatever. So yeah, they need safe notes to be able to do that effectively.
Exactly.
Yeah, love it. Look, one thing as a founder, just to add, like right in the beginning with Cade, we were doing convertible notes at the time because safes were so new in Australia, and you kind of need to work with the market, right? You don't want to have anything working against you as a founder. What it allowed us to do, we got a couple 100,000, and like Quentin was saying, we used it to achieve some milestones. And when you run a price round, you normally have to run the whole thing in one go. So you got to get all the investors lined up. You have to settle it all in the one day. There's normally a minimum. If you don't hit the minimum, you have to give the money back. Like there's all this complexity that you don't have to do with a safe, which just means you can have so much more flexibility as a founder, to just be raising a little bit each month. I have heard some founders saying, oh my God, I would hate to do that. And of course, if you can get it done quickly, please do it quickly. But it's actually really, really difficult in the beginning normally to get your money. And so there's a really nice way to do that. Cal, I might just ask for a favor from you if you can, maybe just to pop a few of the pertinent questions in the bottom of the chat, and then I can work through them. I see you've got your hand up there actually, buddy. Did you want to jump in with a few questions now maybe?
One just there's been quite a number of questions just to elaborate a little bit more around from an investor's perspective on the safe note, right? So we spent a fair bit of time talking about it from the founder's perspective, and Quentin, you covered off a little bit of it, and you're in those shoes. So it'd be great to just maybe spend a little bit more time on that.
So I can, because I was actually going to make this point in terms of David makes another really good point about getting the right people on the cap table, which is always the biggest challenge for every startup, because you want people that provide value. So maybe using a safe early on, or a couple of safes, allows you to get someone who can actually lead you to the lead at the next round. And you want them financially invested in helping you. So you wouldn't be able to build a whole round around that, but you could get them involved with a safe, and then they can start the mentoring or the connections and all these right things that you need to be able to lead to that next price round. So we use it all the time. We'll probably do 10 safes this year. So it's often we're getting very early with our fund, and we help you get to that next stage.
Awesome. Thanks, mate. All right. So look, we're fanging through the time. I think we've covered most of the questions along the way, or thereabouts. If you feel like your question hasn't been answered, please just remind me at the bottom there. We were going to talk a bit about what doesn't work, and we definitely have covered some of those things, or things to look out for. Look out for the complexities of ASIC, definitely. We talked a bit about the discount. That was a good takeaway. The discount's reasonably standardized, and what that is and why that is. We talked a bit about that. I think the more we can standardize that, the better. What about pre-money and post-money? There's definitely been some ongoing, I guess, misunderstanding and/or problems around the pre-money, post-money on the valuation cap, and in general with cap tables, I might add, comes up a lot when pricing rounds. Dave, maybe do you want to talk a little bit about the pre-money, post-money aspect with regard to valuation cap, and how you should prepare your cap table for a round when following best practice?
Yeah, sure. I don't know if there's...
Yes, maybe. I can throw a few things in there. There's a big question.
You almost got me until you said best practice. I think
yeah, okay.
It comes back to, I really honestly, just to follow on something Quentin said, was you're building a relationship with the investor. So you really want to have everyone understand this. So in a way that it doesn't necessarily need to cost a fortune, but I see a lot of people misunderstand this pre and post money because they think, oh, my cap's at 12. Is that a pre-money or post-money? So you need to look at it on a fully diluted basis once it converts, and understand what will you have at the end of that, and it can be pre, in which case if you add your 500,000 note in there, you're going to be, you need to focus on is it a pre or post? I mean, there's no right or wrong. It's just if it's pre money, then it's going to have a different conversion than the post money, because you really, I think, want to look at what am I going to get post conversion to say, well, what did I get for waiting that extra time? So there's no right or wrong. It's just going into it with an open mind. And then a lot of other times I see people, they haven't issued an option pool yet, or they say, well, that's pre, but I'm about to issue 10% option pool. So that can potentially also drag the price down if you don't understand the impact of another 10% being issued. So you really need to understand what the fully diluted position is, because that's really all you're going to have based on what your conversion is.
Awesome. Yeah, I might just continue digging into this one because I see these things regularly being confusing for founders. So which one did you go with, Josh, pre or post? I remember we had a quick chat about that with regard to how the cake standard template is set up in the software. I think it's a pre-money valuation safe, isn't it, the cake one?
Yeah, it is. But actually we had start mates safe as well, which was
yep.
So yeah, luckily we can now pay lawyers and accountants to help us with that, but it's a bit of a blend for us.
For me, the main thing is if an investor thinks they're getting a pre-money safe, but you're actually giving them a post-money safe, and that round is a 20% round, the investor can be getting 20% less investment than they thought they were getting. And you can imagine how that creates for a very unhappy discussion that you do not want to be having with your earliest supporters, especially if they're supposed to be then leading you into, these great new investors that you want to have, like leading your next rounds, etc. And probably what it ends up being, unless is potentially having to give them the better terms anyway, especially if there was that expectation, unless of course you want to have lawyers at 10 paces and things, which is certainly not a nice thing to be doing, in your first couple of rounds. So look, I think a lot of times it's just agreed, okay, whoops, there was a misagreement. There was we didn't understand that correctly. Everything's cool. The second option is, all right, actually, look, here's a few extra shares to make sure we're all friends. The third option is you're going to end up in a fight. Of course, avoid that at all costs, and those sorts of things. But you just don't want any of that. So having clarity around pre-money, post-money, valuation cap is just the way to avoid all those issues. And if you're not sure, of course, talk to someone like Dave, and just get on top of how to set your cap table up, and how to term these things, make life easy for everyone. What other
cake for transparency to see what does it actually mean post conversion, and being able to see post conversion, this is who my shareholders are, how much of my company have I got left to sell after the conversion of my options. You start to run out of control, and that's the other problem. I've seen a lot of founders run out of equity, and that can sometimes be not a good thing for an investor to say the CEO or these people don't have enough of the cap table anymore because they've given it up or they've blown up the cap table too soon.
Yeah, it can happen. And there can be 4, 5, 6 rounds, in reality, until you get to your A round. Of course, nobody wants that. But in reality, you can literally get diluted 15, 20%, 4 or 5 times before you do your first big professional round. So yeah, it's a complicated thing. So just look forward multiple rounds as much as you can. And good investors understand this, right? They understand that you're going to need funding. Like Josh did a great job with his. He pitched his round. He presented it really well. We're going to have a long period of R&D, and we need to get through this whole phase before we're going to be here. And great investors will know that. They'll want to come on that journey in the right way so that your Series A cap table isn't broken, and that you can get those big backers that you need that'll do the ABC with you, that really gets you into that killer position that you're really aiming for, where you can have a huge impact. So I might open up a little bit now just to see if we've covered the things people wanted to cover. Dave, did you want to sort of bring up 1 or 2 things, or one thing to close off that we can maybe chew the fat on?
Well, I think that we've covered a lot of the different things, but I think it's around transparency and making sure everyone understands what you're actually raising and how it's going to affect your dilution, and getting close to the right valuation at an early stage that gets you the momentum that you need to get to the next round. And you mentioned earlier, Jace, that investors are going to want to see potentially a doubling of the next round, but if they've got some notes and you've got some equity, it just muddies the waters about how everyone feels. So I feel like if you can choose a lane and not have lots of different types of things going on, it just makes the next step less hassle. So, and that's one of the things that I think is a big issue, is a lot of people think a safe note's easier, but it depends over what time period you're looking, because you need to deal with the conversions, you need to deal with, because you can always use warrants as well. A lot of people don't use warrants, and you can always get more shares too if you do have a down round. So if you do have a full price round, there's other ways to deal with it, not just doing.
We should do a session on that. Let's set up a session on how to deal with a later stage sort of recap or whatever, Dave. I think that's a really interesting topic. Quentin, how about yourself, mate? Anything to wrap up or that we didn't cover?
No, I mean, Dave's covered a lot of it. One thing I would like to see in this ecosystem is more standardization of the documentation. So, I noticed that YC, StartMate have decided on post money, whatever it is, we need to decide on what it is for this ecosystem. And we need to decide on some standard things that facilitate and get through some of the current issues. And just tailor a little bit for our jurisdiction. But the key thing that YC does is everyone agrees that they've taken this document from the standard template and they've only changed one or two things, like that they're meant to square bracket. And then we need to effectively get to that point here, so people don't have to do the big deep dive reviewing it every time. They know what's in the safe, they know how it converts, they know what they're looking at, and everyone can just spend time investing and building these businesses to be really great companies.
Love that. So watch this space, everyone. Quentin and Dave and I and our relative teams and even our close networks of leaders in the ecosystem are working on a safer note with many of these things ironed out, so we can have more standardization, so we can get these rounds done really quickly. We can have more investment, but we can have less ambiguity around things, and also we can mitigate some of the risks that can come through. So watch this space, and thanks so much for your contributions to this, Quentin and Dave. And Josh, thanks for joining us today. Hopefully, we're appreciative of your contribution, and the founder story is always so important for other founders. So thanks a lot, mate. And look, so for me, the big takeaways I got, and I'm sure you've got your own. Look, the 20% discount, 15-20% discount, just stick in that range and you're going to probably be on the money. Standardizing as much as you can, so stick to that standardization and look forward multiple rounds. Try and model your, think about your safe connected with your next round, and look one round further to make sure that you're doing the right thing by the company, your current investors, but also you're making room for those new investors you want to come through onto the cap table. And for me, just from a risk management perspective, founder to founder, just do that scenario modeling on the downside as well. Just have a look and see if you can't get that next big val, just make sure you're not blowing up your cap table along the way as well. So look, we're right on time. Obviously, important topic. We had about 100 people here at one point leading into Christmas. So really, really grateful for the contributions and for everyone's time. Good luck with the big week leading in, and Merry Christmas, everyone. Oh my goodness, I just said I'm the first person that said Merry Christmas around. Oh, no, I'm so sorry if I've broken the seal there, but enjoy the next few weeks, and we look forward to catching up with you over the next little while. Now we've just made cake shirts, new ones, Albert. So there's a LinkedIn post going out today. So hit up our LinkedIn, anyone that wants a cake shirt. The new one says sharing is caring. So you can choose one or the other, and we'll fire one out for you, mate. So no worries. Thanks, everyone.
Thanks, Jay. Great emceeing, mate.
Thank you.